Welcome to the Peninsula Pensions Full Guide to the Local Government Pension Scheme. Please note, the information in this guide is freely available, but the presentation itself must not be used without the permission of Peninsula Pensions. In this guide we are going to look at what the Local Government Pension Scheme is, the 3 tranches or sections of the scheme, how you can increase the benefits you receive when you retire, the life cover and death benefits, what happens if you leave the pension scheme before retirement age, the scheme protections that exist, information on our member self-service portal, and a summary of your benefits in the Local Government Pension Scheme. So what is the Local Government Pension Scheme? We are a national pension scheme for all local government employees, all teaching support staff, and all police and fire support staff. We operate under central government legislation, and all your benefits are guaranteed, unlike a personal pension, where your benefits are based on stocks and shares, and the value of your fund when you reach retirement age. The pension fund itself is separate from the council's budget, so they cannot take money out of the fund for other purposes. We are currently something called a Career Average Revalued Earnings Pension Scheme, bit of a mouthful, so we tend to call it a CARE or Career Average Scheme. We will explain how this works in a minute. There are 3 tranches or sections to the Local Government Pension Scheme. 2 of these relate to the old Final Salary Pension Scheme, which ceased on the 31st of March 2014, and the third relates to the current Career Average Pension Scheme, which commenced from the 1st of April 2014. The first section of the pension scheme relates to membership up to the 31st of March 2008. Back then the earliest retirement date was age 60, and your normal pension date was between age 60 and 65, depending on your service in the scheme. Your pension was calculated on your membership, in years and days, multiplied by your final 365 days pensionable pay, uprated to the full-time equivalent if part-time, divided by 1/80th. If you were part-time, your service was proportioned with your hours. For example, a member who worked 50% of whole time, for 4 years, would accrue 2 years in the scheme. There was also an automatic tax-free lump sum, which was the equivalent of 3 times your pension. From the 1st of April 2008 the scheme changed. We remained a final salary pension scheme, but the normal retirement age changed to age 65. The earliest voluntary retirement age remained age 60. The calculation of your pension remained the same, but rather than an 80th, changed to a 60th. The automatic tax-free lump sum was removed, and replaced by the option to convert some of your pension for tax-free lump sum. Members who had membership in the first section of the scheme continued to receive the automatic lump sum, based on service up to the 31st of March 2008. Following Lord Hutton's review of public sector pensions, in 2011, to see if they were affordable, sustainable, and fair, the Local Government Pension Scheme was changed to a Career Average Revalued Earnings Scheme, from the 1st of April 2014. The earliest voluntary retirement date was changed to age 55, but the normal retirement age was linked to your state pension age. Calculation of your pension was changed to looking at your pay from the 1st of April to the 31st of March the following year. We then take a 49th of this, add a cost of living increase, and this is your pension accrued for the year. We will explain how this works shortly. The option to convert some of your pension for a tax-free lump sum remained. If you have membership in both the Final Salary Scheme and Career Average Scheme, your retirement ages are protected. For example, your retirement age in Section 1 could be age 60, Section 2, 65, and Section 3, your state pension age. You must take all your benefits at the same time, so to receive your benefits fully unreduced, you would have to take your benefits at your state pension age. Under the Local Government Pension Scheme, the earliest voluntary retirement date is age 55, and your normal pension date is linked to your state pension age. The government is planning on increasing the earliest retirement age, with effect from the 5th of April 2028. This will change the earliest date from age 55 to age 57. If you were paying into the pension scheme before the 4th of November 2021, it is likely you will still be able to take your pension at age 55, but this is still to be confirmed. The change from 55 to 57 will have no effect on ill health retirement, which can be at any age. If you retire before your state pension age, you will suffer an actuarial reduction on your benefits. Now let's explain how the current care pension scheme works. We calculate your pension per annum each year by looking at the pay you pay pension contributions on from the 1st of April to the 31st of March the following year. We take this figure, take a 49th of it, add a cost of living increase, currently linked to the Consumer Price Index, CPI, and the result is your pension per annum accrued for the year, payable at your state pension age. In the example we have here, we start with a balance of 0. At the 31st of March the following year we get told that this person has paid pension contributions on £24,500. We take a 49th of this, which gives a pension of £500 per annum. We add the cost of living increase to it, and at the end of year 1, this person has accrued a pension of £515 per annum. We carry this forward to year 2. At the end of year 2, we get told this person has paid pension contributions on £25,333. Again, we take a 49th, which gives a pension of £517, and add that to the £515 we carried forward. We then add the cost of living increase, which gives us a pension, at the end of year 2, of £1,064 per annum. You can see here the scheme employee contribution rates, from April 2024 to March 2025. The band you fall under is based on your actual annual pay. You receive tax relief on your contributions, in that your pension is taken out of your salary, before you pay tax. The cost of providing you with your local government pension is split between you and your employer. On average you pay 1/3 of the cost, and your employer pays 2/3. If you pay into the 50-50 pension scheme, which we will talk about in a minute, you pay half the contributions. There are 2 sections to the local government pension scheme: the main scheme, and the 50-50 scheme. By paying into the 50-50 scheme, you pay half the contributions, for half the benefits. You can join the scheme at any point during your career. If you have more than one post, you can pay into the 50-50 on one post, and into the main scheme on another. Whilst paying into the 50-50 scheme, you get the same level of life and ill health cover that you do under the main scheme. This is because your employer still pays the full contribution rate. It's a short-term option for 3 years. After that, you will be brought back into the main scheme. You can, however, if you wish, rejoin the 50-50 scheme. As part of your local government pension, you can choose to give up some of your pension, on retirement, to receive a tax-free lump sum. For every £1 of your pension that you give up, you will receive £12 of tax-free lump sum. In the example we have here, the member retires with a pension of £20,000 per annum. They elect to give up £1,000 per annum pension, to receive a tax-free lump sum. This leaves a pension of £19,000 per annum. And they receive a tax-free lump sum of £12,000. There are maximums you can receive, in terms of lump sum. This is 25% of your total fund value. Peninsula Pensions will give you this figure on retirement, and you can also see the maximum tax-free cash lump sum, by looking at your figures at normal pension age, on your annual benefit statement. There are a number of ways of retiring early in the local government pension scheme, some of which are voluntary, some of which require authorization from your employer. Under the current local government pension scheme, you can leave from age 55 onwards voluntarily, but you will suffer an actuarial reduction on your benefits. The reductions will be shown later in this presentation. One of the employer discretions that may be available to you is flexible retirement. Flexible retirement involves you taking a reduction in your hours or grade, in line with your employer's policy. You can then take your benefits, with reduction, and continue in employment, on the lower grade or hours. You can also pay into the local government pension scheme again, on the reduced contract, to build up an additional pension. Flexible retirement is a way of you easing yourself into retirement, whilst your employer keeps your knowledge and skills. If you are made redundant, from age 55 onwards, and have 2 years in the pension scheme, your benefits will come into payment, automatically, based on your service from commencement in the pension scheme, to your date of being made redundant. You will not suffer the actuarial reduction that you would, if you were to leave voluntarily, and take your benefits. If you suffer from any ill health, your benefits can be brought into payment, at any age, and you can be enhanced to your normal pension age, depending on your ability to undertake future employment. You can see here the current reduction factors. If you have membership in all 3 sections of the scheme, the percentage reduction will be different for each section, depending on when you take your benefits. There are 3 ways of increasing your benefits in the local government pension scheme. They are additional pension contributions, APCs, additional voluntary contributions, AVCs, transfer previous pensions to the LGPS. Additional pension contributions involve you purchasing an amount of pension at retirement age. You can pay for it as a one-off lump sum, or as a fixed monthly amount. The cost is based on actuarial factors. By purchasing additional pension contributions, you are buying pension for yourself. It does not provide spouses benefits. If you retire early, you will also suffer the same actuarial reductions that you would suffer on your main scheme benefits. Another option available to you is additional voluntary contributions, AVCs. Our scheme is run through Prudential and is a bit more like a personal pension. You get to choose how your money is invested and can change this throughout your period of contribution. You can pay in as much or as little as you want, stop, start, and vary payments. By paying into the scheme, you are building up a fund, in which you have varying options as to what you can do at retirement age. You can take your fund as a tax-free lump sum, transfer it into the main scheme to buy you pension, or take it to any insurance company to see what it will purchase as a pension. The final way of increasing your benefits is to transfer in other pension rights from elsewhere. This is a time-limited option, and an indication of your interest in transferring has to be submitted within the first 12 months of being in the scheme. If you request a transfer after 1 year, it becomes an employer discretion as to whether to allow it. When making any choices about increasing your pension benefits, you should always take independent financial advice. We recommend that you look at the Money Helper website. It is a government-backed website that will give you free and impartial guidance. The site also gives you access to a choice of independent financial advisors. You can see the link to the Money Helper website here. If you take any periods of unpaid leave, or unpaid maternity leave, you will have a period of lost pension. On return to work, your employer should write to you, and give you the option of purchasing the lost pension. If you make an election to do this, within 30 days of your employer informing you, you will pay 1/3 of the cost, and your employer 2/3. If you make an election after the 30 days, your employer can make you pay the full cost. As part of your local government pension, there are a range of death benefits available. We pay spouses and civil partners pensions. These are based on 1/160th of your membership, in years and days. These pensions continue for life, even if your partner remarries. We also pay cohabitee pensions. For cohabitee pensions, we check whether you are living together and are financially dependent on each other. We do this for a period of 2 years, and would ask for a bank statement in both names, or bills at the same address. We also pay children's pensions, up to the age of 18, and if in full-time education, up to the age of 23. If your child suffers from a disability, they can be payable for life. As part of your local government pension package, you also have life cover. From day one of being an active member, if you were to pass away, a death grant of the equivalent of 3 times your actual salary is payable. Once you start receiving your pension, you are guaranteed 10 years. If you pass away, during the first 10 years, a death grant of the equivalent of the remainder of the 10 years is payable. For example, if you were to pass away 6 years into receiving your pension, a balance of 4 years' pension is payable as a death grant. Peninsula Pensions have complete discretion as to where any death grant is paid. We look to see whether the deceased has a will, or whether they have filled in one of our expression of wish forms. The expression of wish form can be completed on our member self-service, which we will talk about shortly. So what happens if you leave before you can access your pension benefits? If you have been in the scheme for less than 2 years, and you have no other posts paying into the local government pension scheme, or other local government pension elsewhere, you would be entitled to a refund of contributions, or transfer to another pension scheme. We will talk further about the transfer option shortly. If you have been in the scheme for more than 2 years, or have another post paying into the local government pension scheme, or other local government pension elsewhere, you will be entitled to a deferred pension. This is based on your service, to date of leaving, in the pension scheme. Your pension is then index-linked, in line with the Consumer Price Index, CPI, up to, and beyond your normal pension age. You can access your benefits from age 55 onwards, with an actuarial reduction, or at normal pension age unreduced. It is possible to transfer your pension rights to another pension scheme. You must have left your employment more than 1 year before your normal pension age. An option to transfer, other than any AVCs you may have, must be received at least 12 months before your normal pension age. Deciding to transfer your benefits is an important decision, and we recommend that you read all the information and links relating to this on our website, so that you are fully informed of the potential risks with doing so. Millions of people fall victim to pension scams each year. Scammers use such tactics as offering free pension reviews, the promise of a better rate of return on your savings, allowing you to unlock your pension before age 55, offering tax loopholes, or upfront cash, time-limited offers, forcing quick decisions from you, such as using couriers to send documents, so they are signed immediately. Once your pension is transferred, it is too late. You could lose all your pension savings, and in some cases face a tax bill of 55% of the value of the transfer. We recommend that you visit the Financial Conduct Authority website for further information. Details are shown later in this video. There are a number of protections within the local government pension scheme, depending on the period of employment you have paid into the scheme. If you have membership before April 2014, in the old final salary pension scheme, the pension you have built up is fully protected. Your pension will still be based on your final 365 days pensionable pay at your date of leaving. If you suffer from any reduction in your hourly rate of pay, through no fault of your own, there are pay protections in place for your final salary benefits. If you feel this applies to you, please contact Peninsula Pensions for further information. If you joined the pension scheme before the 1st of October 2006, you may have some protection under the 85-year rule. If your age, plus your service, in whole years, equal 85 or more at age 60, you could take your benefits unreduced. The 85-year rule is time-limited, and the amount of protection you receive is dependent on your date of birth. Peninsula Pensions look at this in any calculations that we do. If you were an active member in the pension scheme, as at the 31st of March 2012, and within 10 years of your normal retirement age, you will be eligible for the underpin protection. The underpin protection looks at your pension, if you were to have paid into the final salary scheme, for your whole period of membership, and compares it to your pension in the final salary and care scheme. If the final salary scheme is higher, you will receive an underpin addition to your pension, to bring it up to the same level. In December 2018, the Court of Appeal in England and Wales ruled that this protection gave rise to unlawful discrimination. This became known as the MacLeod remedy, after one of the people who took it to court. This came into force from the 1st of October 2023. You may qualify for underpin protection if you were a member of the local government pension scheme before the 1st of April 2012, and at any time between the 1st of April 2014 and the 31st of March 2022, as long as you did not have a disqualifying break. A disqualifying break is a continuous period of more than 5 years, when you were not a member of a public service pension scheme. You do not need to do anything if this applies to you. Peninsula Pensions will automatically check your pension. Please note that very few members are affected and qualify. If you believe that the pension benefits awarded should qualify for this protection because of previous membership in the LGPS, or another public sector pension scheme that we are not aware of, before the 1st of April 2012, and during the remedy period, please contact us via our member self-service portal, using option 19 of the Contact Us section, outlining the previous service held. Peninsula Pensions has its own member self-service facility. We advise you to sign up to this. Member self-service allows you to do a number of things in relation to your pension. You can view your annual benefit statements. Our virtual assistant will guide you through this in a short video. You can complete the nomination form. This is for any death grant that may be payable on your death. You can run your own pensions estimate, and look at the amounts you would receive converting some of your pension for tax-free lump sum, and you can use our retirement planner, which allows you to look at the style of retirement you would like. The planner will tell you how much you need to save to achieve this. Once you retire, you can view your pay advices and P60s and change your bank account details. You can sign up to member self-service on our website. If we have your email address on record, you will receive an activation key via email. If not, you will receive a letter with the activation key through the post. Once signed up, you will receive all correspondence via member self-service. If you do not sign up, you will not receive any annual benefit statement from us. So to summarize, by being a member of the local government pension scheme, you get a secure annual pension, the option to take a tax-free lump sum on retirement, option to draw your pension between 55 and 75, death benefit cover for your loved ones, and the option to pay into the 50/50 scheme. For further information on the local government pension scheme, please visit our website, www.peninsulapensions.org.uk. You can call us on 01392 383 200. You can also use the Contact Us option within your member self-service account. Further information on the local government pension scheme, together with the additional pension contributions calculator, can be found on the Central Members website, www.lgpsmember.org. For additional voluntary contributions, please visit Prudential's dedicated local government website. For employees of Somerset Council and Devon County Council, please visit your authority's staff internet pages, where you will find further information specific to you. The Public Sector Pensions Act 2013 introduced a requirement for the local government pension scheme administering authorities to establish a pensions board. The Pensions Board assists administering authorities in compliance with the local government pension scheme regulations and any other legislation relating to the governance and administration of the scheme imposed by the pensions regulator. For more information about the board and contact details for your employee representatives, please visit the Pensions Board section of the Peninsula Pensions website. The information contained in this video is the author's interpretation of the current regulations. The information is subject to change, due to various factors, including, but not limited to, changes to rules and regulations, introduced by the Government Actuaries Department, GAD, His Majesty's Revenue and Customs, HMRC, and the Department for Levelling Up, Housing and Communities, DLUHC. Changes can happen at short notice, and may be implemented, prior to the Council issuing any future revised documentation. Readers should take their own legal and financial advice on the interpretation of any particular piece of legislation. No responsibility whatsoever will be assumed by Peninsula Pensions for any direct or consequential loss, financial or otherwise, damage or inconvenience, or any other obligation or liability incurred by readers relying on information contained in this video.